Hello everyone, welcome to the market opening bell on Thursday, November 6, your 10-minute guide to the stock market. Hong Kong stocks opened lower but stabilized later. The Hang Seng Index started the day down 250 points, with the decline widening to 456 points at one point, touching 25,496 points. The drop then narrowed significantly, and by midday, the index had briefly turned positive by 28 points, reaching a high of 25,980 points. It closed down 16 points or 0.07% at 25,935 points. The H-share index fell 9 points or 0.1% to 9,163 points, while the Hang Seng Tech Index dropped 32 points or 0.56% to 5,785 points. Total market turnover reached 238.8 billion Hong Kong dollars. Southbound trading amounted to 95.688 billion Hong Kong dollars, with net southbound inflows of 10.373 billion Hong Kong dollars, compared to 9.832 billion the previous day. Among the standout moves, net buying was strongest in the CSOP Hang Seng Tech ETF at 1.287 billion, followed by Alibaba at 890.64 million, Xiaomi at 650 million, China Mobile at 206 million, and Meituan at 184 million. On the selling side, Hua Hong Semiconductor saw net outflows of 640 million, SMIC 499 million, Bilibili 160 million, and Ganfeng Lithium 101 million. Notably, southbound funds have now net purchased Xiaomi for 6 consecutive days, totaling 3.565 billion Hong Kong dollars, and China Mobile for 3 straight days, totaling 1.42 billion. Meanwhile, SMIC has been net sold for 4 days in a row, with cumulative outflows of 2.825 billion Hong Kong dollars. From a technical perspective, the Hang Seng Index briefly dipped below the lower bound of its 25,600 to 26,600 fluctuation range, but ultimately closed back inside it, showing no clear breakout yet. Over on the mainland, the 3 major A-share indexes opened lower but rallied in the afternoon. The Shanghai Composite closed at 3,969 points, up 9 points or 0.2%. The Shenzhen Component Index ended at 13,223 points, gaining 48 points or 0.4%, and the Chinex Index rose 32 points or 1% to 3,166 points. Combined turnover in Shanghai and Shenzhen reached 1.8771 trillion renminbi. The renminbi US dollar central parity rate was adjusted down 16 pips to 7.0901. China's October S&P Global Services PMI slipped from 52.9 to 52.6, and the composite PMI fell from 52.5 to 51.8. Growth in new orders continued to support economic expansion, though input costs rose at the fastest pace in a year. Layoffs persisted, and intense competition led to a decline in average output prices. In sector news, Hong Kong-listed copper stocks rallied together, with Jiangxi Copper climbing more than 3%. The move came after mining giant Glencore announced plans to shut down its Horn smelter and associated copper refinery in Quebec, Canada, citing environmental concerns and the massive cost of upgrades. While Glencore has not disclosed exact output, industry estimates put the smelter's annual production above 300,000 tons, accounting for about 17% of U.S. imported copper, a development that could significantly disrupt North American supply chains. Aviation stocks bucked the trend and rose, led by China Eastern Airlines, which gained 4.6% and hit a new recent high. Analysts note that efforts to reduce cutthroat competition will help marketized ticket pricing, while steady demand growth and an improving passenger mix are expected to drive airline profit recovery starting in 2026. Travel-related names also performed well. China Tourism Group Duty Free reported a 22% year-on-year drop in net profit for the first three quarters, but declared an interim dividend of 25 cents, 25 red fund, the company's first ever midterm payout. Shares rose 4% to close at 66.95 Hong Kong dollars. Separately, the State Council released the 2026 holiday calendar, extending the Chinese New Year break from February 15th to 23rd, 9 full days, the longest on record. The extra day is expected to spur more travel. Within half an hour of the announcement, searches for train tickets and international flights during New Year and Spring Festival periods doubled on online travel platforms and continued surging. Apple concept stocks, however, kept sliding. Apple's planned mid-2025 rollout of Apple Intelligence AI features in China remains delayed with no new launch date. Its latest quarterly report showed Greater China sales down 3.6% year-on-year, missing analysts' hopes for 9.3% growth after a 4% plus rise the prior quarter. Hong Kong Exchanges and Clearing reported third quarter revenue and other income of 7.775 billion Hong Kong dollars, up 45% from a year earlier and in line with the 7.7 billion expected. Core business revenue jumped 54%, fueled by record cash market volumes that boosted trading and clearing fees. Profit attributable to shareholders reached 4.9 billion, up 56% and ahead of the 4.5 billion forecast. This marks the third straight quarter of record revenue and profit. Net investment income fell 50% to 254 million due to lower fair value gains on external funds and reduced returns on internally managed cash. Operating expenses rose 8% on higher staff and IT costs. The EBITDA margin improved to 81%, up 7 percentage points year-on-year. 4 companies will debut today in yesterday's Philip Mart Grey Market. Vicon Vita Life Sciences, stock code 2630, performed best, closing at 85 Hong Kong dollars, up 154.7% or 51.63 from $51.63 from this IPO price. Excluding fees, each 200 share lot gained 10,326 Hong Kong dollars on paper. The other 3 traded below their listing prices. Ningbo Joyson Electronic at 21.4, down 2.7% or $0.6 for a paper loss of 300 per 500 share lot. Pony AI at 123.5, down 11.2% or $15.5 for a paper loss of $1,550 per 100 share lot. And We Ride, stock code 800, at $23.62, down 12.7% or $3.48 for a paper loss of $348 per 100 share lot. U.S. markets rebounded after private payrolls beat forecast. The Dow closed at 47,311, up 225 points or 0.5%. The Nasdaq at 23,499, up 151 points or 0.65%. And the S&P 500 at 6,796, up 24 points or 0.4%. The Nasdaq Golden Dragon China Index, tracking Chinese ADRs, rose 12 points or 0.15% to 8,137. Among big tech names, Tesla bounced 4.1% after dropping more than 5% the prior day, while Amazon edged up 0.35%. Nvidia fell 1.8%, Micron Technology surged 8.9%, and Super Microcomputer plunged 11.3%. Apple rose a mere 0.04%. Reports say it plans to license Google's Gemini AI model to power a major Siri upgrade, with Apple potentially paying around $1 billion annually for the rights. Meta Platforms gained 1.4%. Its latest quarter results beat on key metrics, but Wall Street fixated on capital spending with AI initiatives in full swing. Meta could spend up to $72 billion in 2025, with further sharp increases into 2026. Investors worry the company is repeating its costly metaverse misstep from a few years ago. Since reporting on October 29th, Meta's stock has fallen from $751 to $627, down nearly 20% in a week. McDonald's posted third quarter net profit up 0.9% year-on-year to $2.28 billion. Adjusted earnings per share came in at $3.22, below the $3.33 expected. Revenue rose 3% to $7.08 billion, slightly under the $7.1 billion forecast. Same-store sales grew 3.6%, reversing a 1.5% decline a year earlier and meeting expectations. In the US, same-store sales rose 2.4%, beating the 1.9% estimate. International markets did even better at 4.3%, and licensed markets grew 4.7%, helped by strong demand in Japan. According to ADP, U.S. private employers added 42,000 jobs in October, well above the 25,000 predicted. September was revised to a 29,000 loss. The rebound appears narrow. The October ISM Services PMI rose from 50 to 52.4, beating the 50.8 forecast and marking a two-month high. The S&P Global Composite PMI climbed from 53.9 to 54.6, though below the preliminary 54.8, driven by gains in both manufacturing and services. The Services Activity Index rose from 54.2 to 54.8, staying above the 50 expansion threshold for the 33rd consecutive month. Our stock pick today is Tingyi, stock code 322. Facing structural challenges in the Chinese economy, Tingyi continues to refine its flagship products, drive product upgrades, enhance per-store channel efficiency, and solidify its leading edge in core businesses and key categories. At the same time, the company is accelerating the development of innovative products and expanding into emerging channels, including live streaming studios, catering, retailing discount stores, and content offering e-commerce. Through multi-dimensional marketing strategies such as campus activities and brand ambassadors live streaming, Tingyi has precisely reached target consumers, significantly boosting brand awareness and influence, especially among younger demographics. In the first half of 2025, group revenue declined 2.7% year-over-year to 40.092 billion yuan. However, thanks to cost structure optimization and improved operational efficiency, the gross margin rose 1.9 percentage points to 34.5%. EBITDA increased 13% to 5.451 billion yuan, driven by the higher gross margin. Profit attributable to shareholders surged 20.5% to 2.271 billion yuan, with basic earnings per share rising 6.8% to 0.403 yuan. By business segment, instant noodle revenue in the first half was 13.465 billion yuan, down 2.5% and accounting for 33.6% of total group revenue, mainly due to market pressures and product mix adjustments. Thanks to price adjustments tied to product upgrades, the instant noodle gross margin improved 0.7 percentage points to 27.8%, driving an 11.9% increase in profit attributable to shareholders for the segment to 951 million yuan. Beverage revenue for the first half total 26.359 billion yuan, down 2.6% and representing 65.7% of group revenue, benefiting from favorable raw material costs and enhanced management efficiency. The beverage gross margin rose 2.5 percentage points to 37.7%, lifting segment profit attributable to shareholders by 19.7% to 1.335 billion yuan. As of June 30, 2025, the group's bank deposits in cash stood at 19.491 billion yuan, an increase of 3.489 billion yuan from December 31, 2024. Interest-bearing borrowings amounted to 15.018 billion yuan, resulting in net cash of 4.474 billion yuan. The net debt to equity capital ratio improved from minus 19.3% at the end of 2024 to minus 35% for the period. Looking ahead, the economic environment remains complex and volatile. The group adheres to long-term principles, focusing on serving consumers and pursuing healthy, high-quality development. It will continue to drive product upgrades and structural adjustments, increase innovation investment, and expand product diversity to offer consumers more comprehensive choices. Tingyi will also strengthen emotional connections with younger consumers, refine channel operations and marketing, improve spending efficiency, accelerate system platform integration, enhance digital technology adoption, optimize revenue structure, boost profitability, and achieve steady performance growth. Recommendation: buy at 11.4 Hong Kong dollars, target $12.5, stop loss $10.9. I do not hold the above stock.